All right, let's talk about LifeStance Health. They just dropped what you could only call a bombshell of an earnings report. The stock? Well, it absolutely exploded. So today, we're going to dig in and break down exactly what was in that report, why it happened, and what this all signals for the future.
Yeah, look at that. Plus 29.9%. That's the number that really tells the whole story here. We're talking about a single day, one trading session right after they released their numbers pre-market. The stock just surged almost 30%. Now, a move that big, that isn't just market noise. That is a fundamental re-rating of the company. So the big question is, what exactly did the market see that it liked that much?
Well, it really starts right at the top. On the earnings call, the CEO, Dave Bourdon, he didn't beat around the bush at all. He basically said, and I'm quoting here, this was a quarter of records, just flat out calling it a record breaker across the board. That sets a super bullish tone, and you know what? Investors clearly bought into it. So, okay, let's look at the numbers that backed up all that confidence.
And that's really the perfect way to describe it. This huge rally was fueled by outperformance on pretty much every single key metric. This wasn't just a narrow beat. We're talking about a comprehensive, huge upside surprise that completely reset expectations for the company's profitability.
Okay, so let's break down these numbers. First up, revenue. It came in at $363.8 million. That's a solid beat, and it's up 16% year over year. Nice. But honestly, the real story here is on the bottom line. Look at that adjusted EBITDA. It absolutely crushed what the analysts were expecting. We're talking by over 14%, and it grew 31% from last year. And maybe the biggest headline of all, LifeStance hit break even on a GAAP EPS basis for the very first time as a public company. They didn't lose money. That's huge, especially when analysts were fully expecting another loss.
And just to put that EBIT to beat into perspective, look at this chart. The street, the analysts, they were looking for something around $35 million. The company came in and delivered over $40 million. That $5 million difference, that's some serious operating leverage. And get this, it was the highest adjusted EBITDA figure in the company's entire history. So of course, the big question becomes, how in the world did they pull this off?
And that brings us to our next section, the productivity engine. The answer to how they did it really comes down to just pure operational execution. See, this quarter wasn't just about strong demand for their services. It was about the company's ability to meet that demand more efficiently than ever before. So let's look at the two key drivers behind this.
So here it is. This is the 1-2 punch that really drove the entire quarter. First, on one side, you have clinician growth. LifeStance added a record 288 net new clinicians. That's growing their base by 11%. Awesome. But here's the real kicker. At the exact same time, their existing clinicians became 5% more productive, and that was the largest quarterly jump ever in the company's history. I mean, think about it. Growing your workforce while simultaneously making every single team member more efficient, that is basically the holy grail for a services business.
And these gains weren't just some fluke. Management was really clear about this. They laid out a whole roadmap pointing to specific durable things they're doing. For example, they're using AI to streamline scheduling and all that tedious paperwork. They rolled out a new cash incentive program that actually rewards clinicians for improving patient access. They've got a new strategic partnership with Calm Health to bring in more high-acuity referrals. And they've even got a tech platform that's making their call center better at converting calls into actual appointments. The point is, these are real structural changes, not just some one-time benefits.
And all this stuff we've been talking about, this operational excellence, it's translating directly into cold hard cash. The company generated a really solid $17 million in free cash flow just this quarter. And for investors, this is such a critical proof point, right? It shows the company's finally maturing into a self-sustaining financial model. It gives them way more flexibility and means they're not so reliant on outside capital anymore.
Okay, so next up, guidance in the street. Because, a great quarter is one thing, but the market is always looking ahead. So let's see how this incredible performance impacts the company's guidance and what Wall Street thinks is coming next.
So after that huge beat, what did management do? They didn't just meet expectations for the future, they raised them. Now, they kept the full-year revenue range the same, but they significantly boosted the outlook for profitability. They raised guidance for central margin, that's basically how profitable their physical locations are, and, this is the crucial part, they also raised the guidance for adjusted EBITDA. To me, that's a huge signal that they believe the margin expansion we saw in Q3 is totally sustainable. And get this, even after that nearly 30% pop in the stock price, Wall Street still sees more room for it to run.
The average analyst price target is sitting around $8.50. From where the stock is now, around $6.44, that implies another 30% of upside. So what does that tell you? It tells you the analyst community really believes these fundamental improvements can support an even higher valuation.
You know, all of this really points to a major shift in the story. For a long time, LifeStance was kind of a classic post-IPO company, right? The story was growth at any cost. Just expand, 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 and we'll worry about profits later. Well, this quarter marks the big pivot. The new story for investors is something totally different. It's about a scaled, efficient, and tech-enabled platform, almost like a utility for mental health care that can actually grow profitably and sustainably for the long haul. Okay, last section here, the next call. So let's put all the pieces together. We've got a blowout quarter, we've got raised guidance, and we've got a whole new narrative for the company. So what's the actionable thesis here? What are we going to be looking for in the next call?
All right, here's our take. First, looking ahead to Q4, we fully expect the company to deliver on its raised guidance. They need to show that those productivity gains from Q3 are for real and they're durable. Second, for the stock price itself, we anticipate a gradual grind higher, heading towards that $8.50 average analyst target as more and more investors start to buy into this new profitability story. So putting it all together, our rating on the stock is outperform. We just think the Q3 results represent a clear inflection point for the company, and we believe the market is going to continue to reward them for this new, disciplined execution.
And that really leaves us with the one key question going forward, doesn't it? We've seen this incredible inflection quarter, but can they sustain it? Can LifeStance actually turn this one blowout quarter into a sustained re-rating of the stock, proving that this new model, this profitable, tech-enabled growth model, isn't just a fluke, but that it's the new standard for the business? Well, that's the challenge, and it's what's going to define the stock's performance from here on out.
And just as a reminder, this is not financial advice.